Welcome to the Real Estate Forecast Breakfast hosted by the Birmingham Bloomfield Chamber. My name is Joe Bauman. I'm the president of the Chamber, and on behalf of our team, our board of directors, and our ambassadors, thank you for coming this morning. What a great room, what a great crowd. We did have to cut off registration a little early, so we're happy to have a full house, and we really appreciate you all coming out to support your industry and to support the Chamber. Before we get started this morning, I do want to make some introductions. First, I want to start with my team. Our operations manager, Cheryl Geralds. Cheryl's way over there in the corner. Our marketing and events manager, Kelly Bennett. Kelly's right in front. And our membership engagement manager, Rachel DeVries. Unfortunately, Rachel is under the weather this morning and wasn't able to join us, but she sends her greetings to everyone. As I mentioned, we have a staff of 4. We have about 650 members, so we have a lot of members to take care of with a relatively small staff, and we couldn't do all the things that we do without the dedication of our volunteers, which are led by our board of directors and our ambassadors. These folks, they give their time, their talent, in many cases their treasure, to make the Chamber a success and to support our membership. So if you are an ambassador or a board member, please stand to be recognized. I also want to recognize the sponsors for this morning's program. Our sponsors help they help fund the cost of our breakfast and our forecast series and really everything that we do. And we couldn't do what we do in terms of programming and having great venues like the Village Club without their support. So this morning we are blessed to have as sponsors. Our diamond sponsor is Clark Hill. Our platinum sponsor is the Bank of Ann Arbor. Our gold sponsors are Fenner, Melstrom, and Dooling, Citizens Bank, and Consumers Energy. Our silver sponsor is the Birmingham Shopping District, and our bronze sponsors include the Farman Group and the agency Hall & Hunter. So thank you for our sponsors. And then finally, I want to recognize our legacy sponsors. Our legacy sponsors are a smaller group of Chamber members who agreed to make a minimum investment in the Chamber on an annual basis, really to support a lot of the low-cost and no-cost programs that we can offer to our general membership. Things like our member coffees, our Chamber 411, and our Professional Edge. They're the underwriting sponsors for that, and we really owe them a great debt of gratitude for doing that. And our legacy sponsors for 2023 include Clark Hill, the Bank of Ann Arbor, SAIC, Michigan United Credit Union, Citizen State Bank, Fenner, Melstrom, and Dooling, and North American Midway Entertainment. So thank you very much to our legacy sponsors. Okay, enough with the perfunctory. We're going to start our program, and it's my pleasure at this time to call to the podium one of our sponsors for this morning's program, which is Lauren Royston from Consumers Energy, who's going to introduce our moderator for this morning and kick us off. Lauren, thank you.
Well, hello, good morning, everyone. I'm Lauren Royston, Community Affairs Manager with Consumers Energy. Thank you to the Birmingham Bloomfield Chamber for having us here today. We are honored to be a partner, and I'd like to share just a little bit of information about Consumers Energy, just so you know that we're a little bit more than the folks that send you that bill each and every month, because it will continue to come each and every month. People, planet, and prosperity. That's our triple bottom line that we live and use as guiding pillars. Consumers Energy has provided reliable, affordable energy to Michigan residents since 1886. Consumers Energy is a combination utility. We're responsible for serving 6.7 million of Michigan's 10 million residents, with close to 1 million customers right here in Oakland County. We are primarily the gas provider here in Southeast Michigan, but our territory includes every single county in the Lower Peninsula. Right now, we're embarking on a 20-year clean energy journey. Our clean energy plan, it's a once-in-a-generation opportunity to transform the way we provide energy to our customers. In June 2021, Consumers Energy announced a sweeping proposal to end coal use by the end of 2025, 15 years faster than previously planned. The plan helps us protect the environment for future generations and positions Consumers Energy as a national leader in the clean energy transformation. The 20-year plan will ensure that we will be one of the first among utilities in the nation to go coal-free by 2025, use 90% clean energy resources, utilize nearly 8,000 megawatts of solar energy to power Michigan's homes and businesses, stay on the path to achieve net zero carbon emissions, create price stability, and save customers about $650 million through 2040. So our plan does focus heavily on increasing renewable energy and energy efficiency to meet Michigan's energy needs. And so we plan to ramp up our demand response, which is a system of rewards for customers to use energy at the right times, and these programs will significantly lower our overall need to build new power plants. And then again, we're accelerating the end of coal use by 2025, dramatically boosting the contribution of solar energy and using natural gas as a bridge. So 1 year ago, we also announced our plan to combat climate change by achieving net zero greenhouse gas emissions from the entire natural gas system. With a 20% customer emission reduction. So essentially what that means in like layman terms, achieving net zero emissions is eliminating the impact of emissions traced to the burning of natural gas by customers and greenhouse gas emissions caused by natural gas suppliers who produce and transport the gas to Consumers Energy through Consumers Energy system. So we know that natural gas is safe and affordable, and we're going to make it even more clean. So in summary, we help Michigan communities thrive. It's our job to make the communities we serve a better place to live, work, and play in energy and beyond. So feel free to find out more information about Consumers Energy at consumersenergy.com/clean energy, or if you're looking for business resources, consumersenergy.com/business. And you'll find lots of resources and information to help your business or to help your company, and with a lot of our energy efficiency programs as well. So the fun part now, I get to introduce our next moderator, Mike Voigt. Mike Voigt helps clients resolve complex real estate issues. This includes representing clients in a variety of disputes related to the purchase, sale, leasing, and management of commercial real estate. He frequently represents national landlords and tenants in lease disputes throughout the country and has litigated or negotiated settlements in numerous complex cases involving both eviction procedures and high exposure claims for damages here in Michigan. Mike also serves as National Zoning Counsel for clients and regularly represents clients at the municipal level to secure zoning approvals of a variety of commercial uses both in Michigan and throughout the country. At this time, I'd like to bring up Mike to kick off our 2023 Real Estate Forecast Breakfast. Good morning.
Thank you very much.
Yes.
Appreciate it. Thank you for that warm welcome. Good morning, everyone. It is an absolute pleasure to be here with all of you this morning, and I'm truly honored to have this privilege of moderating this great event. Now, it goes without saying that we have two fantastic speakers here for you this morning with Todd Shimshak of the Farbman Group and Dan Elsey from Real Estate One, but I'm going to say it anyway. This really is a great panel of speakers. Both Todd and Dan are going to offer incredibly valuable insights into the residential and commercial real estate markets and what we can expect to see in those markets in the near future. So I'll now do what so many of my brothers and sisters in the legal community have so much trouble doing. I'm going to stop talking, and I'm going to go ahead and introduce the first speaker. So Todd Shimshak has been with NAI Farbman since 2005, and over the course of his commercial real estate career, he has, among other accomplishments, developed a very strong reputation for accurate valuations for sellers looking for direction on their real estate holdings. His extensive sales experience includes both distressed and stabilized properties across virtually every commercial real estate asset class. Prior to entering the world of commercial real estate, Todd enjoyed a career in the automotive industry as both a manufacturing engineer and a program manager, but thankfully for all of us, he left that world behind so that one day he could come to this breakfast and speak to us about the commercial real estate market. So without any further ado, let's give a warm welcome to Todd.
Sorry, I hate that picture. And I have a friend in the audience, Cheryl, who must have told you how to say my name. Is that right?
I was prompted.
Okay, thank you. Yeah, because I've heard a lot of variations since kindergarten, and that was perfect. The real Polacks say, or the real Polish people say, Zimchak, like Zimchak, and you look at it and you're like, yeah, that makes sense, Zimchak. And then some American Polacks said Shimshak and confused everybody, and hence our reputation, Polacks. So here we have a picture of where the beautiful people live here within a couple miles of our location here. And I might have to look back and forth a little bit. You know, my CYA disclaimer is, I'm going to point out a lot of facts and opinions. Facts are facts, but I've selected them to support my opinion. And opinions are often wrong, and I might change it tomorrow. But the main thing I want to emphasize here too is, a lot of these broad trends you hear about, talked about, and what I'll mention are very broad. And real estate, more than any other industry, is very local. Sometimes block by block. And you see a lot of things that you should be nervous about in the news about real estate. But within a couple miles of here, you're probably in one of the best spots you could be. So the biggest thing that's on everybody's minds right now are interest rates, of course. From a good friend that's in the commercial mortgage business, his quote the other day to me was, "There are no cash out refis right now, there's only cash in refis." So a lot of owners, unlike us that are blessed to own a home in this country, we have the federal government that's created programs that allow us to have permanent financing that self-amortizes, and we don't come up to these timeframes unless you're on an adjustable rate mortgage in an ARM. And a shout out to one of my other friends in the crowd here, Ted. About a year ago, I was on a 10-year ARM, and I started getting nervous about rates. And I said, Ted, let's do this. Let's just lock this in. And I think I called him the first week of January, and he locked it in. 2 weeks fully approved, and by the end of January it closed. And then the shit hit the fan, and I was very happy that Ted was able to get it done very quickly. So, rates are part of the story here, and one of the reasons why that's stressful for owners right now is there's a lot of rollover in 23 and 24, and when you think about when those rates generally were set, for most people were about 10 years ago in the commercial market. So you had people that are coming off of debt that were at very nice rates. If you look at where rates had been, in 2013, 14, here's the Fed rate right in there, and here's where the T-bill, the 10-year was nice, it was down here. So, the rates have popped, but that's only really part of the story in commercial real estate right now. The other part, of course, is inflation. And if you're in certain asset types, like industrial, where you're not really paying the expenses for tenants, you're sitting really pretty. The demand is high, your rates have gone up, and if you lose a tenant, there's one right there waiting to go in the door. And you're not paying for all their other expenses and worrying about those things. But if you're in an office building with gross leases, or if you're in an apartment building, and granted you had a nice bump the last couple of years in rents, but your expenses have also been climbing up. So it's by default, a lot of office buildings in particular, your expenses are going like this, your rents are kind of going like this, so you're just losing value each year on a gross lease. So combined with those couple things, your note's coming up due, and you have to sit down with a bank again and get a brand new set of underwriting and a set of eyes on. They say, whoa, okay. Not just the rate we got a problem with here, like everything else is also a problem. So that's the biggest challenge for a lot of people right now. So why do we care so much about real estate, and why does the Fed care so much about real estate? And because it's the biggest asset class in the world by far. So you add up real estate across the world, residential and commercial, and it adds up to more than the bond market, the equity market, derivatives, gold, and crypto. And this you can see, like this was year to date through 2022, you can see kind of what the impact of rates, generally the stock market went down of course too, but what rates have really done, and you'll see the things that are struggling most, office, malls, infrastructure is a little surprising, but you can kind of see where those REITs fall, and not surprising, casinos did pretty good. Student housing does surprise me a little bit, but that's probably because they're investing in other markets. Our student housing, there's some markets here, particularly East Lansing and Kalamazoo, that have had some more stress, and we can talk about that later. So how have rates impacted values? This guy, Leo, since the Great Recession, so much of the value that's been driven in real estate have been guys like Leo going around the country clubs, or at a higher level, private equity type of firms going to Wall Street and saying, hey, give me your money. You're not making any money on your money sitting there. So let me go get you a nice safe yield in commercial real estate, and I'll guarantee you an 8% return or a 6% pref return. And they're raising money with other people's money. So their business is driven by doing deals. It's not driven by what is really a great long-term investment here and how much should I really pay for this. So now with that buyer out of the market, because guess what, these corporate guys now on Wall Street say, well, I don't need that guaranteed 8% return. I'm down here with Mr. Bond now, and I can get 5.1% of my T-bills. So I can just sit and wait, and let's just see what happens. So you kind of take those animal spirits out of the market right now, is hence, you're not getting that marginal buyer to push prices. And this, I just threw him in here because this was just one of the most ridiculous things that happened during COVID. I'm sure a couple of you know what that is, but people were paying $70,000, $100,000 for a JPEG, and it was just like, really? Okay. So the other big problem is there's a lot of, I should have said owner's remorse. It's not seller's remorse, but there is no seller's remorse right now if you sold last year. You have owner's remorse if you saw your friends. I don't know if anybody saw the Hartman Tyner portfolio that transacted last year, or I'm sorry, at the end of 21. They top ticked the market. So they average, it was around $1 billion transaction, and I forget exactly how many units. I think it was 7,500 units. So the transaction cost per unit was like $130,000 per door. Before, and some of these were in Southfield, Flint, Detroit, and some of these properties probably would have traded for half of that just a few years before. But again, these private equity style firms were just chasing deals and just really overpaid for that stuff. Now that was a special case because they had a management philosophy that was like, hey, let's just keep rents low and just keep them full. And so there was some upside there, but still, they top tick the market. So then you have everybody else in town going, wow, I just look at my apartment building, it just went up 40% in value. I'm just going to sit and wait because this is just great. And then last year happened, and now they're like, oh, that sucks. I'm going to wait till it gets back again. So they say, well, Todd, bring me an 8 cap. I'll buy an 8 cap all day long. I said, great. Will you sell yours at 8 cap? They're like, yeah, right. So you have this disconnect between values right now that's making it hard to make deals. If you're a forever holder, that's not a problem. But I always encourage owners to just think about it for a minute and say, okay, where do you think rents are going to be in 3 years? If your debt is coming due in 3 years, it's not due now. Where do you think it's going to be in 3 years? Where do you think your expenses are going to be in 3 years? My guess is if you own an apartment building, it's going to be a little bit more of this on expenses and a little bit more of that on rents from here forward. So, maybe it makes sense to look at selling right now. So the effects of inflation, you have increasing inflation in both tenants and owners. So like I said before, if you have gross leases, then you got a problem. If you have net leases, then you're okay because you can pass a lot of that along, at least for now. Let's see. Yeah, I covered some of that. I would encourage owners to, if you can get it, and it's interesting, if you look back at leases from the 80s, you saw a lot of leases written with CPI adjustments in their thing instead of, at some point we got away to this other just, hey, it's 1.5% or 2% bumps on rent. But back in the day when inflation was an issue, you actually did see leases with CPI adjustments. So I think there would be some landlords pushing things back that direction. And of course, if it's anything but apartments, try to get on a triple net lease where you can pass along those increases. Let's see. The other pressure that we're seeing too is, and you're seeing this in announcements from coast to coast right now, is there are a lot of people that are, a lot of companies where their labor costs are going through the roof. And so they're looking around and saying, where can we save money? And hey, nobody's showing up at the office, so why don't we just cut back on our office space? Some good tailwinds. We have Grandma down here. She got an 8.7% raise in January. And we actually all did. I don't know if everybody knows this, but our tax brackets get bumped by the same number. So there's less withholdings right now. So there is that natural stimulus. And I saw the figures. They're about $350 billion just automatically injected to the economy this year alone. So that's, there's bills in Congress where they go out and pat themselves on the back that we spent $350 billion spread it over 10 years. That's 1 year impact. So when you think about that and people are saying, woe is me, the world's coming to an end because of inflation, there's some pretty powerful offsets to that. The job market, I don't know if anybody else has noticed this, but I'm seeing more articles in like the Free Press and Crane saying, oh, this restaurant's open for lunch again, or this restaurant's open on Mondays again. So I think there's some natural healing going on where people are coming back into the workforce. And then you'll see also, we hear about the tech layoffs. They're still growing, but they're just slow. And then you see change in employment, leisure and hospitality. And that's probably an early indicator too, where the economy is headed. When you start to see people pulling back on that, that's when you're gonna probably say like, oh, okay, wait, hold on a minute. Because right now, most good restaurants are still, pretty busy, and airlines are packed to the gills, and hotels are higher rates, maybe not the same occupancy, but higher rates. So the people that want to travel are spending the money. Current tailwinds, you got these guys facing off and taking credit for what they're doing. They got the, gas prices spiked last year, and everybody, of course, was extrapolating with their recency bias, saying, oh my God, gas is gonna go to $10 and oil's gonna be $200, and everybody's freaking out. But, it kind of healed itself a little bit. So the other point of this, though, is like, how much do interest rates matter? It matters a lot for assets. Like, I've heard this called a rich cession instead of a recession. Like, those that have a lot of assets and office owners, they're like, this really sucks. But everybody else is like, I'm getting a raise, I'm going to the casino, it's good times. And also, you can't discount the amount of money that's being pumped into the defense industry right now, and that just has a way of filtering itself all over the place. I'm sure people in Warren are doing pretty good right now, getting some overtime. And some Pollock put this in the wrong place, but in Detroit, the only thing I worry about now and then on the tailwinds right now, I haven't seen in my lifetime. In my lifetime, I know growing up, it was always like, oh, GM laying off 2,000 people, Ford, 2,000 people, Chrysler, 1,000 people, and it's like, man, when does this ever end? But these are, the EV transition is just legit, and this reshoring is legit, and there's all this growth. The only thing I do question sometimes is, once these back order clears of like all the COVID back orders, is that momentum gonna sustain itself, or are we gonna all pull back a little bit now that the average car payment's like $1,000? And then Chinese EVs, like, I don't think you're ever gonna see a Chinese like gas car show up here and people besides the one Buick rebadges as Buicks, like show up here and say like, oh, here's a brand new Chinese brand, but I could totally see a brand new brand introduced to the market that people on the coast don't really appreciate our Chinese. Like, are we gonna buy it in Detroit? Maybe not, but like people in Florida, people in California, an EV shows up in the shores and it's like 33% less than what you can buy here. It's like, sure, I'll give it a shot. So that is one thing I think that could be a potential headwind very down the road. Another tailwind is this $1 trillion infrastructure bill, the $738 billion Inflation Act, the $53 billion CHIPS Act, and about $800 billion in state aid that's still lingering from COVID, that like is still finding ways to be spent, because none of that gets spent overnight. So there's a lot of support there. Moving on to retail. I loved this chart because it compared both what's happened in the last year, or like, this was the end of 22. So, what happened, where things have bounced back just because of maybe primarily COVID, but then also some bigger trends, which I loved that fitness is up from even pre-COVID. This is comparing, the yellow is 2019. So like, even pre-COVID, there's 14% more visits to fitness facilities. Beauty and self-care, we're loving it. And then dollar stores, I question if this is just because they've proliferated like crazy. It might just be the volume there's more options there. You would expect superstores and groceries are fairly flat because that's what we use pre-COVID and now. But the other distressing thing is malls. Like, even compared to 2019, even compared, basically flat from 21, little down in the fourth quarter. But malls are just one area of retail. Overall, retail is doing pretty good. It exceeded everybody's expectations during COVID and coming out of COVID. And lenders are okay with retail. Like, lenders believe that, good retail is going to be fine. So you can get debt for retail. But, certain malls just have not. Right now, you're hearing a lot of stuff in the news about different store closings. But keep in mind, like, that happens every January and February, right? Like, there's retailers that are struggling going into the holidays, and they're like, hey, last stand, let's see what happens here. And then January, February, they're like, done, didn't work, we're moving on. Like, Bed Bath & Beyond's surviving, but they're closing a ton of stores, 400 some stores. And retail is, again, block by block, so specific. One thing that's really changed in the industry is the amount of data. So like this web shopping and returns and everything has generated so much data, like they can pick their locations down to like as a science. So like I guarantee you, like, and it's a tale of two cities, right? So you have Fairlane going to a mall scavenger, and you have like super high-end stuff opening in Somerset. But like when they made the decision to put a Restoration Hardware in Birmingham, which is going to be spectacular, they're looking at data, not just like income data and saying, oh, Ted lives there, he can afford this. They're saying they're looking at their data and they're saying like, geez, like we're shipping so much stuff to 48009. And like when returns come into Somerset, they're coming from 48009. And then and they get, by putting it right here close to home, you're going to ship stuff less back, you're going to take it over to the store, and you're going to spend money when you're in the store. So that's the bricks and clicks type of model that really works well, and that's why they're picking that. Like I read a story in Chicago where they closed an Abercrombie and Fitch, and it was in a decent market, but they moved it 3 miles over because that's what their data suggested they should do. Because when they put that store where the neighborhood was, and it was coming from like an urban environment where there's probably some pedestrian traffic, but nobody's working downtown. And then you put it in the neighborhood where people were actually buying and returning stuff from, their sales went up because people would go there, return stuff, and they'd buy 2 more things on their way out. So it's kind of an interesting thing that's happening. And then we got, CB2 and Birmingham. So these are all, great testaments to the area. What else? Oh, the malls. Yeah, the malls, the strongest ones are doing okay, and it's definitely a tale of two cities. Somerset is crushing it. But then you have, the weakest ones are getting redeveloped, and I suspect that trend is going to keep on going for over the next decade. Probably only the best will remain, and the rest will be, redeveloped into something else. So office space, that's, the stress du jour. You see a lot of headlines here. These are all from the Wall Street Journal just in the last, February. Office landlord defaults, PIMCO saddled with bad bonds. And then Americans working from home, Europeans and Asians are going, which we'll touch on next. So the debt, the long story short on that is debt is very, very hard. It's just toxic to banks right now. And the biggest thing that they call, we get a lot of like loan monitoring calls from banks, and they say, what is the physical occupancy? And we'll literally go over there on a weekday and look at it and be like, well, geez, there's like no cars in the parking lot. It says you're 70% full. And when we used to underwrite like our valuations on buildings, we would probably assume like, okay, a lease is coming due in 2023. It's probably 70% chance, 80% chance that person's been there 20 years, they're going to renew. Now you look at it and you say, geez, I don't know. Like, is it 30%? The reality is like so many of them are just downsizing, staying in place but downsizing, which makes office extremely expensive to own because you had a 10-unit building, and now it's a 20-unit building. You're spending TIs every time somebody's coming in. You're shrinking suites and enlarging suites. And it's not universal. I mean, there's law firms that are expanding, and there's law firms that everybody's still at home or mostly at home. And it's fun. I talk to friends that are lawyers. I said, what are you guys doing? And it's just literally 50-50. Some are saying we're bursting at the seams, we need more space, and some are saying, we're in a couple days a week, so it's really firm by firm. So under 5,000 square feet, there's a really active market of people looking for space. So it's smaller firms looking to grow, or they're saying, I used to have 15,000, I only want 5. So that's a very active market. Between 5 and 10, moderate demand, and then, over 10 is slow, and 25,000 square feet is really slow. I was talking to an owner up in Auburn Hills the other day, the former Delphi building that's now a multi-tenant building there. Off a university. He said he's got 25,000 square foot floor plates. In the last 12 months, he's had 3 showings, to give you an idea. This is a reason why a lot of people are freaking out, or a lot of owners are stressed. So again, you have this wave of maturities coming in 23 and 24. In Detroit, I just highlighted there, we have 32 office buildings that will have maturities in 23 and 24, total loan value $435 million. Some of those will be okay because some of these bonds, these notes, when they took them out, they have automatic extensions or optional extensions where they can extend 1, 2, or 3 times. Some of them don't have any. So if you had an automatic extension where you could make that option, then let's just say half of those did. So they might say, okay, my debt was at 4.5% on this, and now the debt cost would be 7%. So I'm going to extend this. Some of them might say, woe's me, I don't see any value here in the future. Bank, you can have this property. So there's going to be a lot of decisions to make, and that again is different from residential. In commercial, you have those decision points of where your debt is coming due, and you have to make that decision. Do I refi? Do I sell? Or do I throw in the keys? This are national numbers just because they're kind of interesting, again, on national office maturities. So a DSCR means debt service coverage ratio. So if it's 1, it means you have $100,000 of debt payments in a year and your income is $100,000. So they would want that to be a 1.4 to make a new loan. So they want you to have $140,000 to make that $100,000 debt payment. So these are nationally, of the loans that are maturing, there's 233 that are below that number. That means 233 office buildings around the country are going to say, I can't get new money. So that generates some opportunities. It generates, for us hopefully, and then it generates stress for the owners. Why this is highlighted between 1981 or 1990 and down, those buildings are just tougher to lease. People want new, nice stuff. And unless an owner has been really active in updating those buildings, they're considered a little bit antique and passé, and maybe it's not what people want today. So those, again, that just introduces another risk there. They're likely to be lower tenanted. They're likely to have lower rents. And then these are the occupancy stratifications on those maturities. If you're less than 80%, you're probably in this category, so you have some issues there. So again, 228 buildings as of right now are like less than 80%. And again, that's economic occupancy. That doesn't mean they're physical. Like you could be at 80% economic and 50%, 40% physical. So office, I don't know, that got goofed up. So it's complicated. If you own an office building in Royal Oak, Birmingham, Bloomfield Hills, that's where people want to be. So you get calls all the time being like, hey, find me 2,500 square feet in Birmingham. It's like, okay, good luck with that. It's not easy to find. You can have, 20,000 square feet in Southfield tomorrow, but if you want to be in Birmingham, it's pretty tough. So that's a great thing for anybody in this room that owns Birmingham office. Nationwide, just general trend again, suburban office is doing better than CBD, and I'd say suburban urban is doing the best of anything. Again, locations like a Birmingham or Royal Oak, that's where people want to be. The amenity that people want most right now is a short commute and a busy office. I'd say people that have returned to the office and said, hey, I'll give it a try, and they show up and there's 2 people there, they're like, what's the point? So that's going to get into a later debate. And then there's a lot of talk right now about office conversions. Oh, we'll turn them all to apartments. We need apartments. Well, that's extremely challenging. It's extremely expensive, and the location and the building, it only works in a rare case. There was a study, I think it was in the past 3 years, there was let's say there's 70 transactions in New York City for office buildings, and 3 of them were designated for conversions. So just to give you an idea, it's just the scale of it's not going to make a dent. But this was a really good article recently, again from Wall Street Journal, talking about okay, why are people returning to the office in Asia and Europe? In Asia, it's over 100% in some markets, meaning before 2019, compared to 2019, there's more people going to the office and showing up. So, but in Europe, it was about 75%. In America, it's stuck around 50%. And they had some good insights there. Bigger homes for us, longer commutes, and a tighter labor market may help explain why Americans spend less time in the office than Europeans and Asians. And then over here is a chart on the size of homes, in these different markets. So, you look at France, Germany, Japan, less than 2 rooms per person on average. And in America, we have 2.5. So sounds small, but especially in the Detroit area, we're pretty blessed with big homes everywhere. So I think a lot of people just said man, this is nice. I got plenty of space and privacy here. And then the other thing to touch on culturally is, a lot of those Asian markets, you have multi-generational homes. So it's kind of hard to do a Zoom call and you got kids and mom chirping in you. This is another big factor impacting office is sublease availability. And you see, we're on that list where there's quite a bit of inventory that's kind of shadow inventory that the landlord's not controlling. Somebody went out and leased 10,000 square feet they're not using anymore, and then they throw that on the market for about 25% less than the landlord wants in the same building. So that's suppressing also what landlords can do. You'll see Minnesota here. Looked at an office building in Bloomington recently, and talking to the brokers there about what's going on downtown Minnesota, he said it's just an absolute ghost town. It's super sad. And that's why that is leading the country as far as like 1.5 to 2 million square feet of just vacant sublease space right there in Minnesota. And that, we don't have to replay what happened there, but it's sad. It made such a big impact. And you'll see as well, that's Atlanta. Detroit we have a little bit, and then California, we know that's a little bit different story. There's a lot of stuff going on out there. So here's my hot take. Like, what if, less office might be, less productive than more office? So when COVID first happened, I'm fortunate enough, I have an office with a door, and I was like, man, this is great. And like, maybe going forward, all this like open office trend is going to reverse, and people are going to say, wow, let's give our people more office space. That's what they're going to want. There's these communicable diseases and, productivity issues. And a friend of mine worked at Shinola, and they have like concrete floors, concrete roof, and they're in one of these environments, and she would literally have to like put earplugs in to do work. And it's like, okay, so my hot take is, this might look like chaotic and this looks all feng shui, but like, where are you going to do your better work? So my thesis is the office of the future really the office of the past? And, anecdotally, I'm talking to some people that, some of the big three during COVID had said, hey, we're ripping all this stuff out. Come get your personal effects. We're taking out cubes. You're going to be in neighborhoods and hot desking and throw your crap in a locker at the end of the day. And I was talking to a guy like in his 50s, and he's like, I don't ever want to go in the office again. He's like, I can't have a picture of my kids. I can't, go there and do work and feel like I have my own space. And I think the office furniture manufacturers are crushing it, but I don't know if it's really like the best, way forward. Especially if your real estate cost is fixed. Like if you own, Stellantis owns that center over there, it's like, okay, what are you going to do with all that empty space once you take out all the cubes? What's the point? So just anecdotally, and my brother works at Ford, they're doing some similar things, and he's tried going into the office, and they're ripping out cubes, and a lot of people are not excited about working in that kind of environment. So I just think if I can influence like one manager here that's thinking about it, it'd be a good day. So this is kind of a cool article too. So I started doing some research on it. So this is from an article from Wired magazine. It was a bold experiment in creating the office of the future. There were no offices, no desks, no personal equipment, and no survivors. In the end, the employees of TBWA, blah, 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 advertising agency, did what former boss Jay Chiat wanted them to do all along. They got the hell out of the office. And the punchline is here, over several years, they lost business, they lost productivity, they lost connection to the firm, they started losing employees, and at the end of the day, they renovated the offices, brought back offices, cubes, personal space, et cetera, I got rid of it. But the best part of the article is written in 1999. So this has been done before. It maybe works for some people, but I just have a feeling it's going to work for less. So, when will workers want to go back to the office again? We're like trying to encourage them with different things. But I just wonder, this looks kind of dowdy or whatever, but like, man, that's a good place you can be productive, I think. And then that's my dream office right there, and that's for the ladies. So, moving on to multifamily real fast, because I'm probably running out of time. I forgot to start my timer. Rents popped really hard. You'll see this, this is national, of course, but anecdotally, like locally too, I was working at some properties and watching what landlords could do with this new software, where they collude with other landlords to see what the market rents are, and they keep pumping them. And it was rent increases like this. Within a year, I saw rents going from $1,000 to like $1,200, $1,300 at one property. So it was like huge rent increases on what they call trade outs. When somebody moves in, you get a new tenant, boom, great, new rents, reset. But it is kind of like rolling over a little bit. So that's where that inflation versus rent increases is going to start to bite a little bit. I think demographics drives everything. So, if you're an owner and you say, where am I on the curve on multifamily, like who rents? Here's 20 to 30. we see where, this was 21, by the way, but, you see where renters were. You're kind of at that peak right here in this area here, and now it's maybe a little bit less. But where I worry about is, like, say, student housing. If you look down the road a little bit here, these folks, let's say they're 17 right now, you might go into like a localized bump, but then look what happens after that. These are age category, like by age, our national population from the Census Bureau. This is why the guys in the senior homes do so well. This is see that dark red? That's the senior C plus of women right there. So anyway, so that might help the senior living. Right now, senior living really didn't get off the mat fully from COVID. People changed. They said, I don't want to go in those places. Plus, we had a ton of supply hit the market right before COVID. They built the crap out of that stuff. And now people are saying, whoa, I'm going to wait on that. But the demographic curve is, headed that way. The other factor I think is interesting in new supply. There's so much new supply right now. And I think that the old supply that's kept itself up is going to be fine because the old supply has bigger units. The new stuff coming out has so many studios and ones, and they're just doing that to optimize on a per square foot basis. It's so expensive. Am I out of time? Okay. All right. So I'm out of time, but if you want this, I just want to point this out, how strong Birmingham is real quick. So this is the Pearl. Look at these rents. 2 bedrooms, $5,500 for a grand 1,400 square feet. The taxes on this are between $9,000 and $10,000 per unit. That's pretty rich. So this is a new one going up on Adams. I expect they have more units there to spread some cost over, so maybe the rents aren't quite that high, but like if you were looking forward to getting in that place, you better start saving up. Industrial, real quick. Industrial is doing awesome right now, but this article was in Crain's just this week, and it really made me give pause. This year alone, developers are expecting to bring to market 16 new speculative warehouse developments with over 5 million square feet of space. That figure rivals the past of 10 years combined. So just think about that. I mean, nothing goes to the moon. Maybe we need it all, but we're going to find out pretty soon, I think. So anyway, that's it. I'll give you my card, come up to afterwards, and I can email this to you. Thank you very much.
Thank you, Todd, for that highly informative presentation and forecast as to what we're going to see here, what we are seeing, and what we will be seeing in the commercial, retail, office, industrial spaces. As I mentioned earlier, our second speaker this morning, as you can see from this picture to my right, is Dan Elsey from Real Estate One. Dan currently serves as the president of brokerage services for the Real Estate One family of companies, where he and his brother Stuart share the leadership. The company's in its 4th generation here in Michigan, having begun as Elsey Real Estate in 1929. Everyone in this room knows of Real Estate One. It would be hard not to, as it's the largest broker in the state of Michigan with 89 offices and 2,400 sales associates throughout the state. In 2022 alone, the Real Estate One family of companies handled $6 billion, that's billion with a B, in sales, and completed over 32,000 transactions in brokerage, mortgage, title, and casualty insurance. For the sake of brevity, I'm going to cut out a few pages of Dan's accomplishments, board memberships, leadership positions. But he has been with the company since 1983, starting in commercial real estate then moving to residential as a regional vice president, and finally into his current role in the year 2000. In summary, Dan knows the residential real estate market inside and out, and we are incredibly privileged to have him with us here this morning. So with that, let's all give Dan a welcome to the podium.
Good morning, everyone. Well, in the interest of time, since we seem to be running a little late, real estate market is great. It's wonderful. There are butterflies floating around every realtor, and we're just so happy, and the world is great. I've got a clicker here. How many of you, raise hands, think the real estate market is doing really great right now? Boy, you're a pessimistic group of people. How many of you think, as Todd said, you think that the world is in the shit right now? Raise your hand. You're not sure. That's why I'm here, I guess. Yes, to let you know. All right, so here's what's going on. So first, who turned off the hose? And that's happened last year when the interest rates went up. And one of the things that we have to sort of decide as a homeowner. There are a lot of realtors in the group today, so the perspective, I guess, to think about is as a homeowner, and all of you, the homeowner, home buyer, the market's doing pretty good. Don't worry, things are fine. As a realtor, mortgage lender, title person, there's a little bit of worry because we're coming off an insanity and now to more normal. And whenever there's a change, doesn't matter what's going on in terms of where it was and where it is, whenever you have an inflection change, that causes stress. People are comfortable with consistency. When the market's going up, even if the market's going down, it's consistent and people get comfortable with that. When you have that inflection point of change, which is where we're at now, it causes a lot of stress. So 2021, those the realtors in the room know, that were probably the two best years in the history of real estate in the nation and in Michigan as well. Very wild, crazy. If you were buying and selling a home, we were just, as the prior one here, just the fire hose. And now the world has changed, and it is a good thing that the world changed. As much as the market has slowed down dramatically, it was necessary because we were headed for a bubble. We were headed for a crash. You can't have year over year 15, 16, 18% appreciation rates year over year and not have something bad happen eventually. The scars of 2008, 2007, in our world, it started in 2006, are still fresh in most of our minds. So it was good that there was something that happened that changed it. And quite frankly, the insanity that caused it was Treasury and Fed-based actions to try to keep the economy going, keeping interest rates artificially low. And then when it was time to fix it, they've moved interest rates to artificially high, which is where we're at now. So we're in that teeter-totter seesaw world of trying to rebalance things. So what to do? Should I sell? If you are a consumer, sell, buy? Should I be dancing in the street? Should I be hiding in my basement? Should I be dancing in my basement? What should we be doing right now in the marketplace? And the answer is it depends on where you're at. It isn't the typical, well, it's always a good time to buy and always a good time to sell. It really depends on where you are in your needs and where you are from your lifestyle. Are you moving up, moving out? Are you renting? All of those things. Because a market change like this does cause each of you who are trying to make a real estate decision to make that individual decision, because it is different. So you get a lot of noise, a lot of headlines. These are some fresh ones. This is one that is great from CoreLogic. U.S. home prices continue their gradual free fall in January. Now there's an oxymoron if I've ever heard one. What is a gradual free fall? U.S. foreclosure filings surged 115% in 2022. So you see a lot of this noise. This is why you hesitated to raise your hand, because you see these headlines about this massive shift in the marketplace. We're coming off of insanity to normal. We're still normal. There still is a significant shortage, if you've been in the market, of homes for sale. So yes, it's painful when you go from insanity to normal. Look at, even you mentioned the tech industry and the tech industry laying people off. It's not so much that the tech industry is collapsing, it's just that they had anticipated growth like this, and growth is just like this, still growing. Well, they were anticipating this. And in our industry, particularly in the mortgage side, we were anticipating and trying to manage this fire hose of all these refis and all this low interest rate activity, hiring, and then interest rates and activity changed, and now we have to readjust our world. Still strong. And you hear a lot of terms like everything comparing to post-pandemic and pre-pandemic. We're just getting back to the pre-pandemic world of where we were. And quite frankly, the sales will have to, because everything sort of returns to mean. When you're above average, at some point you have to go below average to make up for the average, because the average is always the constant, if you remember your economics in high school or college. So we were above the average for a while, and now we're going to be below for a little while till we catch back up again. And here's a shocking thing that we did a detailed analysis, spent years analyzing this. It turns out that interest rates and home sales are related. We were shocked by this. And it's a direct correlation. The sharper the interest rates go up, the faster the sales fall. So you can see here, we'll go back. We had a real sharp increase, so guess what? We're going to have a sharp decrease in activity. Surprise, surprise. And here's another shock as well, is as interest rates, the spread between the interest rates people have right now and the current rates also influences things. And that's one of our biggest things to manage in our industry, in the real estate industry, is so many of you have sub-4, even sub-3% mortgages. And you're just not going to be rushing to change that anytime quick, unless you have to. And a lot of housing is a have to. It's birth, it's death, it's divorce, it's change, it's all those things, and those you have to do. But a lot of that is discretionary too. So I have to, but I don't have to today. So I'll kick that I don't have to down the road, and that's when you get the fluctuation of business. That's what we're in now. We have that discretionary buyer or seller is saying, let's see what happens. I don't have to rush into the market. And we also are suffering from the fact that in 20 and 21, we borrowed a lot of transactions from the future. So that activity was, and the rates were so low and so exciting, and we all had, from the real estate world, we tend to deal with the top 20% echelon of earnings because those are the people who can afford homes. So that part of the economy was flush with cash. So you got the overbidding. People had low interest rates. They had money in their pockets. They were going crazy. So people bought forward. We saw that really in northern Michigan. Our northern Michigan operations saw it the most. And if any of you were trying to buy a cottage or a home in northern Michigan over the last few years, you realize how wild it was. We were attracting attention across. COVID created a whole new opportunities for us. We usually, if you go to Northwest Michigan, most of the buyers are Grand Rapids, Chicago, and Detroit, 80%. During COVID, 50% were New York, California, and Texas and Arizona. And if you were trying to buy a beautiful home on the bay for $1 million and you're from typical Detroit buyer, you made a bid, and then someone flies in, some whippersnapper flies in from Silicon Valley that just sold their 800 square foot studio for $14 million. And they say, $1 million, hell, I'll pay $5 million for that one. And it just got crazy. And values went wild. And that's the portion of the state right now that is also feeling the change the most. Values there are not quite shrinking, but starting to shrink there a little bit, and certainly demand has as well, as they've realized that they're getting that carry forward business is starting to hit. So one of the issues that we watch is when you buy a house, you're really buying a payment. Just like we buy a car, you're buying a payment. So what are the payments? And right now, because of interest rates rising and because of the buildup of home values rising from 2021 going forward, and even going back to 2012, the slow rise from the last recession, we now have the typical payment of a typical family is up to 25%, which is where it was actually in 2006, 2007, pre-crash. So when it gets up into that range, that's an automatic governor and slowing down activity. You get to a certain level, and as much as a buyer wants to buy, they simply can't because they just don't have the income. And when you look at, you'll see some other charts here. And I'll send you all these charts. I'm going to go through them in the interest of time very quickly. But they all show that gap between demand and supply. And what's strange about our market right now is that it is very schizophrenic, because there are portions of the market where it is a supply issue. There are plenty of buyers. There just aren't any listings. And there's portions of the market and different price ranges where it's the opposite. It's a demand problem, plenty of supply or a reasonable amount of supply. In general, supply is still squeezed across the board in all price ranges, but relative to the last few years, a reasonable amount of supply, and it's demand that shrunk. So it is very schizophrenic, very local. So when you're analyzing your own home and where you are, or for the realtors in the room looking across the marketplace, it is very, very specific and very local into what's going on. So what's going to cause a housing crash? Well, I don't think there's anything right now on the horizon that's going to do that. What we're seeing now, the market we're going through now, is 2008 without the foreclosures. It's what would have happened in 2008 if we didn't have foreclosures. And the advantage that we have, and you could say statistically, this is a real estate recession. Again, look at those headlines. There's probably a headline somewhere out there that says there's a real estate recession out there. It's all relative, and technically it might be correct, but again, we're coming off of a crazy market to a slow market, and that percentage change probably does qualify, but it's still a good market. But for that reason, there aren't a lot of foreclosures. And what caused the value change and the crushing feel for 2008 through 12 was foreclosures. With value was a significant drop in value. And that's not going on now. And there's nothing in the foreseeable future to cause that. So in general, what we're going to see for the next few years is what we're seeing now. Relatively speaking, it'll be tight inventories. It'll probably get better and better, but in general, there'll be fewer homes available than most buyers would like to have in their choices. And sellers will be pleasantly surprised that although the market is slower, there aren't as many homes being sold, that their home values aren't going to crash. Might go down. Chances are, we think chances are that you'll probably give, of those 2 years of crazy, insane 15, 18% appreciation, you might give one of those years back. So the person at risk is the person that probably bought late 2021. And if they have to sell now or at the end of the year, they might be one that might see a value change. What they sold it for is not what they're going to get it for. So that's approximately 0.5% of the market. So a small percentage might have that issue, but the rest will be very, very pleased when it comes time to sell their home. So there are three factors that influence the housing world: household income, home values, and interest rates. And when those get out of balance, something has to adjust. And the natural laws of economics and capitalism cause those to balance. And right now, with interest rates rising, something has to offset that to rebalance the market. And the offset to that are home prices. And what's interesting is that home prices haven't fallen yet. We've been expecting them to fall, and they haven't. And the reason for that is the household income. You mentioned before that as much as there is conversation about inflation taking buying power out of the marketplace, households still have a lot of disposable income, and they're making up for the interest rates by their ability to buy. Again, some, but sales are off 20%. So that means a significant number of potential home buyers are saying, no, that balance isn't there. And the way that I'm going to offset it is I'm just going to hold back in the marketplace for a while. And in doing so, bring back home values a little bit. As demand falls, then home values start to normalize. So this is the chart between, I mentioned earlier about Treasury and Federal Reserve and their view on interest rates. So this is a surprise, again, one of those shocking correlations. As the Treasury buys more bonds, interest rates go down, and as the Treasury stops buying bonds, interest rates go up. Surprise, surprise. So the Treasury has stopped buying bonds, and that's what caused the interest rates to rise. It was less the short-term interest rates, the Fed's rising, Fed fund rates, is less influencing on mortgage rates than the fact that the Federal Reserve stopped buying mortgages, stopped buying bonds. That's what really caused rates to rise. The interest rate trending is good. It's down. It's about 6.5% plus or minus now. Probably, if I were to guess, I'm not an economist, luckily. But that's the joke. They say economists have successfully predicted 9 of the last 3 recessions. So, and that's what we're in now. Are we in a recession? Aren't we in a recession? It's hard to tell. You only know when you look backwards over time. But interest rates probably should be in the mid-5s. If you were to take away the government efforts to balance the market and try to keep things on an even keel, and they probably should have been in the mid to low fives from 2010 forward. But they were artificially low even back then. And that was good for housing, good for homeowners, because it did spur activity coming out of the Great Recession. So it was a good thing, but sometimes too much of a good thing can cause a little pain. Recession, in general, does mean lower interest rates, and that will happen. If I were to make a prediction, and most of you will forget I made this prediction, so I can say whatever I want. A year from now, you'll forget it. But I would say that the Treasury and Fed will probably overreact, raise rates too much. If there's a true recession across the economy, they'll panic and they'll drive rates back down again. They'll start buying bonds quickly and they'll drive rates down. And that is the reason why I say that. It's not much of a stretch of a prediction, because that's happened in every one of those instances there. That's what the Fed has always done. So we expect them to do the same thing. So we think rates will be coming down. And that's why if there's advice that realtors give their clients is buying today in this market with rates as high as they are isn't a high risk, because odds are rates are going to go down and you refinance. And those of you in the room that remember that when you bought homes when rates were, go back to the 80s, 13, 14, 15%, or even the 90s in the 8 or 9% range, that's when you tended to buy the best value, and then you refinanced out of that and you were doing really well. So it isn't bad. It sounds counterintuitive, but it's not bad advice, because you can, what's the term that we say in our industry is you marry the house, but you date the rate. So that's temporary. This is Michigan. Case Schiller does a report for home values. They do a very good job of that. They lag a couple months, so it isn't as late as current as it could be, but it's very good in terms of home values. That orange line is the trend. It's about a 3% appreciation has been the long-term trend for Michigan forever, except that you notice that long-term trend, how many years did it actually match that long-term trend? Hardly ever. It's always above or always below. On average, 3%, but it's rarely in any one year. So what we took back leading up to the Great Recession, we gave away afterwards. And now this little bump at the end is the same thing. What we took away or what we got the last couple of years, we're probably going to give away. So at the end of that chart, you can see our anticipation that absent of something significant, the recovery in terms of number of homes sold getting back up to where they were in 2021, it's probably 3 or 4 years before it gets back up to that level. Not a bad thing, again, because that level was too high. Just like in 2006 and 2005, the level was too high. Home prices, you can see, and this is a good example of we were up. Now, this happens to be a national chart. Take about 3 points off for Southeast Michigan. We didn't get as high as the rest of the country, but you can see it peaked, and now we're down into the 6% year-over-year value appreciation. And this goes through November. If you go through February, it's probably more like 3.5%, 4% now. And I'll show you some of those numbers in a minute. Also, recessions don't necessarily mean home value declines. If a recession is based on housing, if housing is the cause of the recession, then they suffer the most. Anything that causes the recession, if it's auto housing, that's the thing that suffers the most. But in a lot of recessions, actually home values went up. This is the general consensus, is that home values will drop 5 to 7% during this shift, whether it ever becomes a recession or not, at least the shift in our industry. It'll be about that much. But there's some that are predicting, let's see if I got, yeah. So here's those economists that are predicting 9 of the last 3 recessions. They run anywhere from a 2.5% increase to a 5% decrease in values over the next year or so. And the reality is that they have no idea. And it's okay to say you have no idea. It's okay to say this market is weird and we're not sure, because it is weird and we're not sure. And none of you have been in a real estate market, experienced a real estate market like this in your lifetimes. It is unique and different. So how we all react to it as an economy and as a society is going to be slightly different. We can predict based on some history where the world is going. And what we can see is that there isn't anything dire. As much as the headlines are talking about horrible things, in general, it's a pretty healthy market. Your values are not declining. What's interesting is how stubborn, as much as the prediction is values are declining, how stubborn you all are that are sellers. You're not dropping your prices. And how stubborn and optimistic buyers are. They're willing to pay. We're still getting, 38% of our transactions are multiple offers. Used to be 65, but 35. If there wasn't a 65, 35 would be the record number. But we had a 65. So it's all relative to where we were and where we are. This is a relative, one of the headlines was foreclosures were up 115%. Yes, it went from 1 to 2. So foreclosures are not an issue, and don't worry about them. They will go up, and you'll see headlines of them doubling and tripling, but in fact, for most realtors would say, we hope foreclosures quadruple because we really need the listings. We really need the inventory. We don't need the horror on those poor families, but we need the inventory. Listings are down as well. As you can expect, the marketplace, average days on market are there. We follow showings activity. That's a leading indicator. Are people looking at houses? And you can't see the chart, but when you get it, you can get in the details of it. In general, there are as many people looking at houses now as there were in the last few years. We go back to 2019, a little less, maybe 8 or 10% fewer. That's our demand piece. So demand is down, but not dramatically down. Number of homes selling within 10 days, again, up a lot, but not up as much as it was in 2019-18. And our price reductions before selling, so I lowered my price and I sold, which is another indicator of our values, home values higher than they should be. And that's risen dramatically, but again, still less than it was in 2019. But these are all indicators that the market is it's settled to a more normal market. It is still a seller's market. It's not a buyer's market yet. In the upper end, the higher you get, the closer it becomes a balanced market, maybe slightly towards a buyer's market. But it is still, the seller still has the bargaining power, not as much as they had 2 years ago, but they still are in the best position. This chart shows homes for sale versus under contract, and the wider the gap, and the one under 750, and this is for Birmingham, Bloomfield area, under 750, that tells you that demand fell when interest rates went up. That's that big drop, faster than supply. Whereas in the upper end, it was pretty even. And throughout the shift in the market, we've been waiting for the upper end to settle, and it took forever. It just started doing it now for the first time. But it was all through last year, the upper end was the hottest segment of the market. Anything above 750 was really strong. And now it's starting to settle, catch up with the rest of the market. So here's Oakland County and Birmingham in terms of transactions, new listings, pendings, and price per square foot by price range. And in general, the number of new listings coming in the market is down, again, except for the upper end, where it's starting to rise again. Listings are coming back in the market. Pending sales are off pretty dramatically. But then, they're off based on the first half of last year, which is really good. So it's off of a really good to just good. And price per square foot, you can see, actually is down a little bit in some areas, but overall is still showing some stability. We expect that prices to decline a little bit, but not dramatically so far. So what are we looking at? One of the trends to be aware of if you are a homeowner, and this is hard sometimes to swallow because it's your home, but there is a wide gap between move-in ready and everything else. And the homes that are move-in ready, which move-in ready term, realtor term, what that really means is you've updated your kitchen, you've gotten rid of the shag carpet, you fixed the 80-year-old landscaping up front, you've basically updated your home. And that's always been the strongest segment of the market. But for a couple of years, you could have had a 1980s shag carpet, you haven't changed anything, and it's still sold in a heartbeat. That's changed. That gap has widened. So you'll see homes that'll sell over ask price, multiple offers in a neighborhood, and the next door neighbor will sit on the market. And the difference basically is decorating and updating. It's a big gap. So that's come back. That was gone for a couple of years. That's now back. So that's to be aware of in terms of where you are and what your home is. Creative financing is back. They were doing buy downs and doing some things to make, because demand is less. And the best way of thinking about it is that demand has dropped, but so has supply. So it's an active market, just smaller, 20% less than it was before. And logically, you think about it, 60% of all buyers have a home to sell. So if buyers stop buying, they also stop putting their homes on the market. So it's a natural thing to have inventory decline. In 2008, we had the same thing happened, except a whole bunch of those sellers didn't want to sell, but they had to. So it was a one-way ticket. They put their homes in the market, but they were not buyers. So we had a flood of inventory. That's not going to happen this time. So what we expect, home sales to be off 10 to 15% this year. Home values, again, depending on range and where, in Birmingham, Bloomfield, Royal Oak, the suburban urban markets will fare the best. The outlying markets will feel more of the change. A cute bungalow that a first-time home buyer wants to buy will get multiple offers because the first-time home buyer segment is the largest segment. The most demand is there. A four-bedroom colonial in Farmington Hills, which is the smallest buying segment, will sit on the market longer. There'll be a gap in product type as well as geography. But in general, home values 3 to 5%, inventories probably will start to rise, but still historically remain low, and that'll be for a few years. Interest rates, we think mid-5s to low 6s. And really the inventory won't shift, won't break loose, basically until anyone in this room that is over 60, if you don't decide you're going to sell your house, because you're the problem. You're the problem. And we joke, eventually you're going to have to sell. It'll probably be under a sheet, but eventually you're going to get out of that house. And we're patient. We'll wait. But it really is. Boomers they're more active. They're living in their homes longer. They're working longer. It is a different generation than their generation, their parents' generation. And as much as that is wonderful from an economic standpoint because they're in the economy longer, buying, active, and it's good in that place, from the real estate standpoint, they tend to stay in their homes longer. So the average home ownership used to be 7 years. It's getting close to 10 or 12 now. Some of that's economic issues coming out of the recession, but some of it is lifestyle. So that will change over time. That will be released over time and start that access of more supply over the next 5 years or so. So for going forward, majority of homes will be selling in weeks and months and not days. Activity will be lower, so whatever your neighbor saw a year ago is not what you're going to see when you put your home on the market. It won't be as crazy. 25% of the homes we expect still to have multiple offers. It's higher than that now still. Inventories will remain low. Demand will remain down, but so will inventory, so it'll be a very balanced market, just a smaller market. And we think that any home value decline, which is probably likely, again, we may give back one of those years, but as incomes rise, because the good news about the issue, there's always silver linings in anything. Inflation has caused incomes to rise. When inflation goes away, those incomes aren't going to go down. So you're going to unleash some buying power that will offset interest rates and unleash buying power within the so we expect a pretty good jump in activity and home buying activity, probably not this year, but into next year. And that's it.
Okay, as the owner of a 4-bedroom, 3-bathroom home, I'll let all of you in the room know who are realtors when I'm ready to sell. So we'll work on that supply a little bit. Again, I want to just wrap up by saying thank you to our speakers, our moderator, our sponsors. I want to give a shout out to our photographer, Doug Ashley, who was snapping your picture as you were milling about and networking, to Bloomfield Community Television for capturing this morning's program, and that will be available from our website on a link. So if you have some of your coworkers, colleagues who weren't able to make it this morning that you think would benefit from the information that was provided, they can watch it on at their leisure, and we'll also make all of the PowerPoint presentations available as well to all of our guests this morning. So thank you very much. We do have one more forecast program this year. On April 5th, we will be right back in this room again for our healthcare and healthy workforce forecast. So please mark your calendars. Again, thank you all for coming. It was great seeing everybody. Make it a great rest of your week. Thanks.